Hello, all. Good evening and welcome. I'm Mamta Rawat from the Corporate Communications team of CareEdge. I welcome you to our discussion today on telecom infrastructure connecting India's digital future. We sincerely appreciate your taking the time to join us for this webinar. We would like to welcome our esteemed guest speakers for today. Mr. Arpit Gupta, Executive Vice President, Corp Finance at Vodafone India Limited at Vodafone Idea Limited. Mr. Arvind Vashistha, Executive VP, Head of Credit Risk and Policy at National Bank for Financing, Infrastructure and Development. Dr. Sushil Kumar Chaturvedi, Chief Executive Officer at Ascent Telecom Infrastructure Private Limited. This session will be moderated by Hardik Shah, Director at CareEdge Ratings. We will commence this session with a presentation by Arti Roy, Associate Director and Group Head at CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key into their panel. We will take up your queries at the end of the discussion. Now, may I invite Arti Roy to make the presentation.
Thank you, Mamta, for the quick introduction. Good evening, everyone. I once again welcome our elite panel members who have joined us today. Let me begin the presentation with the key messages. India's moderate teledensity and internet penetration presents scope for high growth for India's telecom market, which is already the second largest globally. The accelerating adoption of 5G is expected to be a major catalyst for surging data consumption. Consequently, future average revenue per user (ARPU) growth shall be primarily driven by increasing data consumption and tariff hikes. However, to create large-scale, high-speed 5G network capacity, sizable scaling up, base transceiver stations, towers, and fiber network is essential. We believe adequate balance sheet strength of industry players coupled with the government's infrastructure push shall support telecom infrastructure development. In the medium term, we see healthy tenancy growth potential, which shall drive improvement in ROC for telecom infrastructure players. However, industry players shall have to navigate risk from emerging technologies and government regulations. We have broadly divided today's presentation in three key segments. That is telecom industry. We will be covering tower infrastructure and also fiber infrastructure segment. Let's begin by looking at how the subscriber base has held up despite the recent tariff hikes. As seen in the figure on the left, the telecom industry's wireless subscriber base has remained largely stable despite the tariff hikes. Between FY16 and FY21, the base grew at a CAGR of 2.7%, reaching 1,181 million subscribers as on March 31st, 2021, driven mainly by the lower pricing amid heightened competition following the entry of a strong new player. Post FY21, the subscriber base has held steady despite two tariff hikes up to 25%, the first one in December 2021 and the second one in July 24, along with the SIM card consolidation. Looking ahead, we expect continued growth support by India's rising population, declining age of mobile ownership, improving smartphone affordability, and increasing rural penetration. The chart on the right illustrates the consolidation in the telecom industry following Reliance Jio's entry. Over the past decade, Reliance Jio and Bharti Airtel have steadily gained market. Going forward, we expect the market share of key industry players to remain largely stable over the medium term. While the subscriber volumes have held firm, let's shift focus to the operating metrics that define the sectoral health. The chart on the left highlights the aggregate operating performance of telecom service providers. Revenue grew at a healthy CAGR of 12% over the 3 years ending FY25, accompanied by a 450 bps improvement in PBLTT margins, driven by the rising ARPU and high operating leverage. telcos made significant investments in expanding 4G and 5G networks, which was partially funded through debt, resulting in elevated gearing of 2.21x and total debt to PBLTT of 5.87x as on March 31st, 2023. However, gradual monetization and Government of India's funding support to Vodafone Idea and BSNL have improved the financial risk profile, with gearing reducing to 1.18 times and total debt to PBLTT to 4.42x as on March 31st, 2025. We expect sector leverage to improve further, supported by a decline in capex intensity following the extensive 4G rollout and initial 5G deployment. Next, we explore the capital intensity behind these 5G rollouts and its impact on the return metrics. As shown here, telcos have completed large capex exceeding rupees 3 lakh crore over the past 3 years, including spectrum purchases, placing pressure on the sector's ROC, which remains modest at 5% despite the gradual improvement. Industry players acquired 5G spectrum worth rupees 1.5 lakh crore, led by Reliance Jio with 25,000 MHz, followed by Bharti Airtel and Vodafone Idea, which had 20,000 MHz and 6,000 MHz respectively. To offset the pressure from heavy investment, boosting ARPU remains pivotal. Let's take a closer look here. In order to generate adequate returns on their 4G and 5G investments done, it is imperative for the telcos to significantly improve their ARPU. While average ARPU has already improved steadily from rupees 98 per month in FY21 to rupees 174 per month in FY25. However, this remains inadequate, and substantial improvement in ARPU is required going forward, which is expected to be supported by the growing data usage, tariff hikes, and premiumization of customer base. We anticipate a 20% tariff hike in the later half of the current fiscal, which could improve ARPU to the extent of rupees 200 to 210 per month by FY26 end. While over the medium term, telcos may need to target an average ARPU of rupees 260 plus per month to ensure sustainable returns on the capital employed. Having covered telcos' dynamics, we now turn to the backbone of mobile connectivity. Moving ahead on the next slide, India's tele-density stood moderate at 82%, while internet penetration stood relatively low at 62% in FY25. Though internet penetration has improved over the years, it stood substantially lower compared to the developing and developed countries, as we can see from the chart on the right side of the screen. Now, this highlights significant headroom for growth, provided telecom infrastructure and services are adequately expanded across the country, including the remote and the rural regions. Building on this, let's analyze the tenancy growth prospects and financial trends in the tower segment. So, as we see on the left side of the screen, telecom tower companies have steadily expanded their portfolios in line with telco rollout plans. The number of macro towers increased from 490,000 at FY20 end to 641,000 by FY25, with the tenancy ratio remaining stable at about 1.4x. We expect tower companies to add sizable towers in FY26, driven by 4G expansion plans of Vodafone Idea and BSNL and the continued 5G rollout by Jio and Airtel. If we look on the right-hand side, the PBLTT per tower saw a sharp uptick in FY24 and FY25, supported by the recovery of the past overdue receivables and recognition of revenue for the same. However, this is expected to normalize to approximately 39,000 per tower in FY26. Now, let's evaluate how these trends have translated into healthy return metrics for tower players. So, as seen on the left side of the screen, telecom tower players have recorded consistent revenue growth over the 3 years ending FY25, driven by an expanding tower portfolio, including the acquisitions from the telcos and a largely stable tenancy ratio. Exceptional profitability and ROC in the last 2 years were supported by the recognition of past revenues following the improved collections. Accordingly, ROC also improved sharply in FY24 and FY25, which we can see from the right side of the screen. However, the same is expected to normalize in FY26, but will remain healthy over and above 14% in the medium term. Improved profitability has also enhanced leverage capacity for these companies, making room for future growth. So, with improved collection efficiency, gearing and liquidity profile of these tower players improved significantly, marked by the gearing of 1.5x as on March 31st, 2025. Accordingly, telecom tower players now have a comfortable gearing to fund expected capex of approx rupees 11,000 crore in FY26 and growth plans thereafter. From towers, let's move to the fiber segment, which complements and extends the digital infrastructure. Moving on to the optical fiber cable infrastructure. The rollout of fiber network remains time consuming and challenging due to right of way approvals and the need for significant upfront investment. These constraints have accelerated the adoption of fixed wireless access, that is FWA broadband, which saw remarkable success in FY25, reaching 7 million subscribers within less than 2 years of launch. Going forward, we expect FWA to take center stage, whereby subscriber numbers are projected to grow from 7 million at FY25 to about 25 million over the next 3 years. In comparison, fiber based broadband is expected to grow more gradually from approx 41.4 million subscribers at FY25 to nearly 50 million by FY28. Additionally, the surge in 5G data consumption, anticipated to account for approx 50 to 60% of total data usage by FY28, will necessitate a substantial increase in the number of fiberized base tower units, that is BTUs. Accordingly, the next phase of fiber rollout is expected to be led by BTU fiberization, complemented by targeted FTTX deployments in high population density areas. This naturally leads us to fiber network scale, where rollout momentum continues to build. Driven by the aggressive fiber rollout initiatives taken by players like Reliance Jio and Bharti Airtel, along with rural deployments under the BharatNet project, India's optical cable network expanded significantly from approx 35 lakh route kilometers in FY22 to around 42 lakh route kilometers by FY25. Looking ahead, the fiber network is expected to reach 47 lakh kilometers by FY28. This would be supported by an estimated capex of approx rupees 1 lakh crore. Lastly, let's explore the policy tailwinds and the government initiatives that is supporting this transformation. To support the rapid development of telecom infrastructure across the country, the Government of India has undertaken several strategic initiatives. Under the key project of National Broadband Mission, that is BharatNet project, has laid 6.93 lakhs route kilometers of fiber, connecting approx 2.14 lakh gram panchayats and enabling almost 12.81 lakh FTTH connections to ensure the last mile broadband access. Further, the launch of National Broadband Mission Phase 2 in April 2025 is expected to drive substantial expansion of fiber and tower infrastructure even in the remote regions. To address operational challenges faced by the fiber companies the government has also introduced the Gati Shakti Sanchar portal, a centralized online platform designed to streamline the right of way approval process. Additionally, a composite billing scheme has been implemented to simplify the billing for multi power connections used by tower companies. Moreover, the production linked incentive PLI for telecom equipment manufacturing, along with reduced import duties on critical component, is expected to lower capex intensity and enhance the cost efficiency for telecom infrastructure providers. Moving ahead, to summarize, let's look at some of the key monitorables. Pace of 5G penetration and growth in data consumption shall be a key monitorable, since this is important for timely and adequate monetization of 5G investment by telcos so as to improve their ROC. Medium-term tenancy prospects for tower companies shall be determined by 5G network expansion across the country, where telcos seems to have taken calibrated approach post initial 5G rollout. Pace of fiber deployment to be largely driven by the 5G uptake and consequent increase in need of fiberized towers, whereby FTTX expansion is likely to moderate amidst rapid expansion of FWA. Competition from satellite-based internet do not seem to be an immediate threat to terrestrial network due to its significantly high cost and capacity constraints, and likely to complement connectivity in the areas where terrestrial network is weak or do not exist. However, any cost-effective rapid technology evolution in satellite-based network would be the one key watch out. While the regulatory framework is conducive for telcos, especially with waivers such as the relaxed bank guarantee norms, any adverse regulatory changes affecting telcos could have downstream implications for the infrastructure providers. With this, I conclude the presentation here. Over to you, Mamta.
Thank you, Arti. Attendees are requested to key in their questions, which we will take up after our panel discussion. Now, may I invite Hardik to take over the session, please. Hardik Shah is a qualified chartered accountant and a CFA and has over 19 years of industry experience with a focus on corporate credit ratings. At CareEdge Ratings, he has led various rating teams across diverse sectors. Over to you, Hardik.
Thank you, Mamta, for the quick introduction and Arti for an insightful presentation. A very good evening and warm welcome to everyone who has joined us today for this webinar. We welcome our esteemed guest speakers for today. Let me introduce the speakers in an alphabetical order. Our first guest speaker for today is Mr. Arpit Gupta. Mr. Gupta serves as Executive Vice President, Corporate Finance at Vodafone Idea Limited. He has over 21 years of experience, including nearly 18 years in the telecom sector itself. Prior to Vodafone Idea, he held important roles at Bharti Airtel and Bharat Petroleum Corporation Limited, contributing across finance and strategic functions. He is a rank-holding chartered accountant known for his depth in corporate finance, capital structuring, and financial stewardship within large-scale enterprises. A very warm welcome to Mr. Gupta. Our second guest speaker for today is Mr. Arvind Vashistha. Mr. Vashistha is a part of the leadership and founding team at NaBFID, where he heads the credit risk management and policy function. With over 2 decades of experience in infrastructure and corporate finance, his expertise spans credit risk control, underwriting, and equity investments across banks, financial institutions, and corporates. Before NaBFID, he served as corporate credit head for wholesale banking at IDFC First Bank, playing a key role in the senior leadership team. He holds an MBA in finance from the Sydenham Institute of Management Studies and Research and a bachelor's in instrumentation engineering from Mumbai University. A very warm welcome to Mr. Vashistha. Our third guest speaker for today is Dr. Sushil Kumar Chaturvedi. He is the Group CEO of SN Telecom Infrastructure since 2012. With over 3 decades of experience in the telecom sector, He has led operations across India, Southeast Asia, and Africa. He previously served as CEO of ORG Informatics, Vice President at GDSSI in USA, and Director at BSNL. His international assignments include serving as telecom advisor to the International Telecommunication Union for the SADC nations. Dr. Chaturvedi holds an engineering degree in electronics and telecommunications from NIT Kurukshetra and a PhD in management from the University in France. He has been recognized with the Presidential Medal for his distinguished service in the telecom sector. A very warm welcome to you, Dr. Chaturvedi. My sincere thanks to our guest speakers for joining this session. It's time to quickly set the context before we begin the discussion. As we saw in the presentation that over the last 3 years, we saw significant capex by telecom service providers, especially for 5G rollout. And in line with that, we also saw associated infrastructure expansion, both in the form of tower and fiber assets. While the capex from the telecom service providers is now expected to moderate, capex intensity for tower and fiber assets is expected to continue for some time for a greater 5G penetration. On the back of sizable capex, return on capital employed of telecom service providers, which we saw in the presentation, remain impacted. There is an expectation of tariff hike in the current financial year, so as to improve ARPU and ROC in turn. As far as tower and fiber assets are concerned, they continue to have healthy ROC. The returns are expected to improve with improved tenancy ratio going forward. While there are few gray areas and open issues wherein we would like to know the views of our today's panel members. So with that context, let me request Mr. Gupta first to share his initial thoughts around when and to what extent do you see tariff hike by telecom service providers, given the fact that sizable investments towards 5G deployment is already done and ROC are really low. Over to you, Mr. Gupta.
Thanks, Hardik, for this opportunity. And I think before I respond to the question that you are asking, that how do we see the tariff increase opportunity in India, I think what is very critical to understand that when we talk about the last few rounds of the tariff increase in 2023 and before that in 2021, I think what we had kind of missed that what industry has seen between FY16 to FY19 a significant amount of tariff pressure and the ARPUs getting down to a significantly low level. As we see over a period of last 4 to 5 years, ARPUs have improved at the industry level. But even as we look at these improved ARPU levels, we are, I'd say, even if I look at the next comparable country, we might be just less than half of it. So if you see in terms of tariff increase, I think media just keep on reporting something which is on a percentage basis. But if you look at in an absolute sense, 300 rupees moving to 350, and this is something for a service which is essential. The way you start your day to the way you end your day. Telecom and the connectivity is something which just helps you across your morning activities to night. And in that sense, the kind of, I'll say, the value the mobile connectivity creates compared to what a user pay on a monthly basis, even if I look at it at the industry level, let's say maybe close to around 200 to 220 odd rupees, where we are at this point in time, which basically means somewhere around 7 or 8 rupees in a day. So I think there is a way to see, how do we look at ARPUs? To some extent, we got into this kind of a situation because the way the ARPU plans are structured, and this may not be a right way in a long term. So at some point in time, industry has to find a right way. I don't want to get into the detail, but principally speaking, ARPUs should increase. Now, whether that increase just on the basis of a given tariff hike of 5%, 10%, 20%, in 6 months, 12 months, 20 months, or whether industry gets into a little different kind of a pricing model, those are the things that we need to see. But yes, I think the point that you are making, there is a need for a tariff increase. The other thing that we need to see when we talk about in terms of ARPU comparison, India with any other global and comparable economy, I'm not getting into some smaller countries, but the data consumption in India is again maybe 3x of a comparable country. So when we talk about ARPU, it is half. When we talk about data consumption, it is 2x, 3x. So nowhere in terms of economics, you see that these are the trends which can continue for a long time. Industry has moved into a direction because of multiple other external factors, and everyone is aware about that. And in that sense, I think I'll not say 20% price increase, but I'm saying a price increase. How do you differentiate between different set of customers? A given price increase on a monthly rental of 50 rupees, 60 rupees, 80 rupees is something which has to happen.
Got it. Understood. So it's on the cards. When and to what extent it will happen, that we'll see. But I think the views are echoing. We also feel there is a need for a tariff increase. Probably the industry will tell when exactly that happens. I got your point. As a follow-up to this question, my next question is for you, Mr. Chaturvedi. As 5G adoption improves, as we all expect, because telcos have done a sizable capex, and now it's a time for penetration. To what extent do you see an increase in demand for the additional towers, so as to ease the network congestion, or are the existing towers, because we saw the tenancy of around 1.4, that is an average tenancy. So are the existing towers will be able to take care of this incremental requirement? What will?
Thanks, Hardik. See, as 5G adoption accelerates, especially in the urban centers, we are definitely seeing an increased demand for additional towers, particularly in the small cells and the rooftop sites. Because unlike 4G and 3G prior to that, 5G, especially in the mid and high bands, it requires a much denser network to maintain the low latency and high throughput, which are the USPs of 5G. So while macro tower growth may moderate, but we'll see a significant uptick in microsite deployment. My guesstimate is that at least a 20 to 25% increase in urban tower density we should be witnessing in the next 3 to 5 years. And then smart cities, enterprise campuses, and transit hubs, they will further drive this need for additional tower density.
Got it. So we will look forward to a sizable capex from the tower companies, probably in the coming 5 years period. I got your point. Now let me move to Mr. Vashistha to gain some view from the other side as a lender. So according to you, what are the key risk factors you see while funding a tower or a fiber assets these days?
Yeah. Thank you, Hardik, for inviting me to the webinar, and thank you, Arti, for the insightful presentation. Coming back to the question that you posed, Hardik, on what are the key risk factors. For lenders, the key risk factors or the key credit matrices, largely remain the same. We obviously, other than the sponsor obviously is a something very, very critical in all of these assessments. Other than the sponsor, on the business side, we generally looking at the portfolio in terms of what's the size, the stickiness, what are the terms of the MSA in terms of the visibility, the escalation, the lock-ins, etc. Another peculiar aspect, of course, well known, is the tenancy prospects for that entity, which would include both in terms of diversification, how much is captive, how much is third party. We all know tenancy ratios have been declining. They're currently stabilizing at around 1.35 to 1.4 for the industry. And as my fellow colleague just mentioned, there's a huge capital intensity, which is actually being witnessed in this. So the tenancy prospects is something that lenders are usually concerned about as a part of the assessment. A critical requirement is also this capital intensity, the CapEx requirements and recovery of the same, which lenders would look at. There are multiple tenancies which would come in, which would give their additions at a later stage, whereas the capex has to happen immediately. So a great deal of assessment also goes in terms of whether the entity which is carrying out it in what kind of a period of time they would be able to recover that kind of a capital investment into the entity. What I'm referring to here is largely the risks which are focused on industry and business side. Needless to say, the risks on the financial assessment remain critical. And one critical item in the financial assessment risk, which has been plaguing this industry in particular in the past, has been the working capital cycle, which is essentially the assessment on the receivable side. That of course has come down to very, very very, very satisfactory levels now. But that's something that lenders, tend to look at while assessing these entities.
Got it. We saw that the collection cycle has improved. Almost 2 months is a kind of collection cycle which we saw. So I think that's pretty comfortable. So thanks, Mr. Vashistha, on that. Now moving back to Mr. Gupta, while you give us a fair understanding about the tariff hike, which is more of a short-term thing, in the slightly longer horizon, say coming 2 to 3 years period, how do you see the ARPU one? You gave us probably a 6 months to 1 year horizon, but on a longer horizon, where do you see the ARPU so as to have proper ROCs in place?
So Hardik, again, I think the way we need to see this, and I think one of the competitor is very open in terms of saying that what should be the ARPU, then they kind of publicly mentioned some of the numbers on the call. I don't want to get into terms of repetition of that.
Understood. Understood.
But what I'll say, in terms of, let's say, the larger investment that the industry is making, and it is having an implication, as I was saying, across the customers, across the infrastructure players and all. And at this point in time, I think telecom is the wireless, if I say the telco operators are the only ones who are not generating sufficient ROC. Now, different operators have different kind of balance sheet strength, and they may continue to have some kind of a low ARPUs for a given period of time. But if you principally ask me, how do we see this in a long term? As I'd kind of alluding towards that in the long term, either we keep on getting into these, and again, I'll not put a percentage because whenever you talk about in terms of an ARPU increase on percentage, it appears to be very high. But if I say, on a daily basis, can I increase by 2 rupees, 3 rupees, 4 rupees in terms of ARPU? I think this is how the industry has to think about it. At some point in time, I think, whatever way or whatever name you call it, but can we get into something which is what we used to have as a telescopic pricing, where, as you consume more, you pay more, but your per unit of consumption, the rate continues to come down. So I think it is difficult to say what is the right way to think about it. And industry has to find its own way in terms of how the industry thinks about the pricing in the long term. But I think given moving back to something which is different compared to the current pricing structure, that will take little time. And in that sense, I think whenever next round of price increase happen, most likely that should be on the basis of some incremental, 2 rupee, 3 rupee per day kind of an increase that has to be taken into account.
Got it. Got it.
The other point, I think the question you were asking with reference to 5G investment, and I think, see, India is again a very different market. If you compare with China, the spectrum, which is the key raw material from an industry point of view, used to be kind of largely administratively allocated or with some kind of an administrative pricing that is required to be paid. In India, operators have committed a larger chunk of investments towards spectrum. And that is also something which is required to be factored into when we talk about the pricing. And that's why, principally speaking, why the ROCs are significantly low, because the operators are making larger investments both on the infrastructure as well as on the spectrum side.
Got it. Understood. Now let me touch upon very critical and pertinent issue about tenancy ratio. So here my question for you, Mr. Chaturvedi, is that how do you see the tenancy growth for telecom tower business? So do you really see the tenancy ratios which we saw in the presentation at around more or less steady at 1.4 to improve, say, in the next 2 to 3 years horizon, or do you really see the actual tower infrastructure or the tower numbers to go up?
So that's pertinent question, I would say. See, tenancy growth today is more nuanced. Traditional tenancy, as we used to kind of consider, which was adding multiple operators on a single tower, is plateauing. And that is primarily because of the industry dynamics as we see today, with the active MNOs, being limited. However, with 5G, what we are seeing is equipment densification, even without additional tenants. And that is, to a larger scale, which will continue to increase, as 5G accelerates and more use cases come to fruition. Apart from that, there are new use cases as well, like private 5G networks, industrial IoT zones, and then the emerging rural connectivity schemes like BharatNet, USOF, right, being pursued by the government. They are expected to drive incremental tenancy. Then infrastructure sharing advantages, which have been witnessed already, and passive asset monetization are also going to encourage the operators to lease rather than build. So this basically is now the new norm when we talk about the tenancy ratio.
Got it. Got it. Understood. So moving to Mr. Vashistha, how do you see the challenges with respect to right of way, especially for laying fiber networks, as towers typically do not need much of land, but especially for fiber expansion, you would have seen a lot of projects. So what's your experience with respect to right of way related challenges?
Yeah, I mean that's very relevant, Hardik. So we have seen that there is a huge improvement which is happening the way we are seeing this whole right of way issue for fiber assets, and rather than the challenges which possibly we have industry players and they can also shed light on this. I think I would actually want to touch upon three items which really seem to have contributed to the improvement on these challenges. One is clearly the telecom rules of 2024, which came in, which lenders are feeling they kind of provide a unified, transparent framework across states. There's a mandatory timeline which has come in there. I think it's approximately 70 days under which the decisioning has to happen on the right of way, and there is a validity of the ROW, which kind of is coterminous with the actual license. The second aspect, which I think was also touched by Arti in her presentation, was this whole Gati Shakti portal being a single window system for providing a very speedy ROW applications and approvals. So that we are also witnessing, and it's not just in telecom or the tower assets or the fiber assets, but also in several other infrastructure initiatives. This single window portal has helped a lot. The last is that Department of Telecom also requires the states to implement the ROW rules of 2024 without any specific local legislation. So it is kind of a mandated to states also to follow them right from day zero. So what we are feeling from the lenders community is that these three changes have really helped bring down the challenges on the ROW to a significant bare minimum. Happy to also hear from Mr. Arpit and Dr. Chaturvedi more from an industry perspective. But lenders are really feeling that a significant improvement has happened on the ROW side on this.
Understood. So you really see that changes on ground is what I understand. Right.
Right.
Understood. So my next question is on the internet penetration for you, Mr. Gupta. So how do you see the internet penetration in the India in coming few years, given that in spite of significant growth we saw in the last few years from 50 to almost 60 to 63% internet penetration we saw, it still lacks when we see in comparison to the few other countries. So how do you see the internet penetration and what all factors you would contribute for its improvement?
Hardik, let me put it this way again. When we talk about internet penetration, and let's say, as I was trying to explain earlier, that mobility is something which is part of a daily life for most of us. But even if I look at otherwise, and before I get into the internet penetration or broadband penetration or 4G or 5G, how penetrated those services are, I think there are two things that we need to really look at. One, when we look at India, in terms of overall mobility penetration, when we see we are still close to around 81-82% of population. This again, when you compare with any other larger global countries, they are more than 100% in terms of just penetration. Uh, in India, I think again, when you look at the rural penetration, and this is again, I'm saying just on an overall basis before I get into the broadband specific thing, rural penetration is still something that is 59%. So there is a larger opportunity available in terms of overall subscriber base in India to improve. And why it is important to understand it, because as we see, in telecom, there is a path that most of the customer follows. People generally join, they get comfortable with voice. And again, this is I am saying with reference to now the incremental opportunity that we need to talk about. So for those set of customers who have not witnessed connectivity so far, the first point of connect is they start understanding what is the difference a wireless connection can make to their daily life. So a carpenter, say for example, just started getting businesses for 10 days, 15 days because of having the connectivity, then he will continue to remain connected onto a mobile. Now, as this customer started to remain connected on mobile, as their income levels increase because of the connectivity and all, the next level is they start getting into an handset replacement, higher quality of handset, and that is where the data need started to getting built up. And I think given the change the voice to data makes to their overall life, that is something which allow them to get into a more or marginally more in terms of spending. Now, if you see in terms of data penetration specifically, whether I talk about 4G or 5G and 5G, and maybe we get into a little more detail on 5G specifically separately, but from a customer point of view, 4G connectivity is something which is very critical. And if you see India, we are currently close to around 65-67% of 4G penetration. And again, this is significantly lower compared to any global standard. So this is something which has to improve significantly. And if I say from an mobile operator's point of view, there is a significantly larger amount of opportunity which is available to all the operators. We just need to see how do we plan that and how do we achieve that. So far, if I see over a period of last few years, given there is easy opportunity available to most of the operators, I think the focus was not more in terms of the industry expansion, but just to get what they can get from the market easily. And I think as we get into a more stable industry scenario, I think industry itself will start moving towards how to improve the penetration over a period of time.
Understood. So, but this you said in the context of tariff hike, how do you see the penetration to again improve? Because on one side we are saying tariffs are really low, and we also acknowledge that. But on one side we are going for increasing the ARPUs, and on the other side there is a penetration thing. So, do you really see both these things to juxtapose, and we see improvement on both sides?
I think I briefly touched upon this point. As I was saying, there are two set of segments that we really need to look at for a customer. And again, this is not nothing new that we are talking about. If you see any of us go back to 2016, we were paying close to around 2,000 rupees, 2,500 rupees in terms of our daily connectivity. And at that point in time, any of us was having a data consumption of 1 GB, 2 GB. Currently, I don't know whether how many of you monitor your data consumption, but I can say for sure, even if you are not monitoring and you just see what is the data consumption that you do on a monthly basis by default, because there are so many apps, everything has started moving on to HD. The video quality has changed by default. Even many of us who are into the profession, which allows us little less screen time, but by default we would be using more than 25 GB of data on a monthly basis. So that is the change that has happened. Now, if you see over a same period of time, instead of paying the 2,500 rupees, now you are paying maybe 600, 700 rupees. So I think this is where the industry has to see how do we need to define the customer segmentation. And what I was trying to say that in terms of telescopic pricing, that the people who consume more of a data, while their per GB pricing may go down, they will continue to pay me higher. Now, whether we can move exactly to the same kind of tariff structure which was prevalent in 2016, most likely the answer is clear no. But can we find a balance in between? That is something what I was trying to say, that industry has to find a balance. So this is one part. Now the second part, when we talk about in terms of the entry level pricing and all, this is, I think generally we are very clear that we have already moved that entry level from 0 to 29 to 39 to 99, and now maybe close to around 149 to 199, somewhere in that bucket. I think making any further large changes to those kind of price points may be little difficult, but onto the other side of the price points, there is a larger amount of opportunity which is available, which will allow both to address the growth that industry require in terms of new subscriber coming to it, as well as to improve better, revenue from the set of customers who are currently using it extensively.
Got it. Understood. Now, I have an interesting question for you, Mr. Chaturvedi. Recently, we saw a big ticket M&A in the tower segment wherein ATC got acquired by Summit. So that's one part of the story. So do you really see further consolidation in the tower business, especially looking at any overlap situation as far as tower portfolios are concerned?
Yeah, see the ATC summit that you just deal that you just mentioned, it signals a broader shift, in fact. See, as the margins tighten and capex pressures grow, we should expect more consolidation, especially among the regional players or those portfolios where they've got redundant footprints. Because overlap in urban areas where tower density is already high, it creates inefficiencies. Now, consolidation helps basically in optimizing the tenancy ratios. It reduces the site OpEx. It unlocks synergies. Therefore, we should expect more M&As, but the activity will be mainly to focus on rationalizing the assets, enhancing energy efficiencies, and then preparing these portfolios for long-term 5G and fiber demands. So that probably would be the guiding force for further consolidations.
Understood. Now moving to take the lender's view, Mr. Vashistha, how is your level of comfort when you go and fund a tower or a fiber business on a standalone balance sheet, vis-a-vis it being a part of an InvIT? So you would be funding a project in a standalone entity, and if it is a part of an InvIT, what kind of comfort you get and how differentiate approach you have as far as funding this two side of it?
Right. So, funding InvITs is now, quite very well established. Let me put it this way. But if you look at the benefits, which are kind of well studied and well known by now, there's a clear diversification of assets which is happening both in terms of numbers as well as geography, which augurs well for the lenders. There is a significant reduction in concentration risk which happens at the InvIT level. There's a definite improvement in the leverage. And needless to say, there is an improved governance structure because on account of regular reportings and disclosures. Now that's obviously the key benefits that one sees in InvITs, and this has been well proven. If you see in sectors such as roads, such as power transmission, so on and so forth. What we think is clearly that from a lending perspective, as long as you have stable cash flows that are coming in the InvIT, they would be able to attract both the investors and lenders' interest. Obviously there are these issues pertaining to that trusts are not today included as a part of IBC. So security enforcement is something that obviously is a challenge today for structures like InvITs. Having said that, most of the lending that we're seeing in the telecom towers or fiber asset business is a cash flow based lending and not really a collateral or asset backed lending that is happening. So it really augurs well if you are seeing assets under InvIT versus being on a standalone basis.
Understood. So definitely, it's an added probably a comfort which you get while funding an InvIT.
Yeah, just one more point here. What's also important equally is that and this is more important for the investors, that they typically like that the InvIT is not an passive one; it's more an active one, which continuously adds on assets. So that's also an important perspective that one has to bear in mind when they're looking at InvITs, because a lot of those leverage considerations which are there are based on future growth around the InvIT structure. Yeah.
Understood. Understood, but counter argument around that, because today you are aware about the portfolio and all. Tomorrow, an asset is getting added that definitely do not need the lender's approval. So probably won't it dilute the comfort which you have? Obviously, an operational asset will only be added to the InvIT. But
So
yeah.
Yeah. So, the lending framework for InvITs has developed very well on this aspect. So, if there any future asset is added, obviously it should not really result in any credit metric being, coming down for the InvIT, including the ratings, etc. So, lenders have those checks and balances around it, but purely from an investor perspective, obviously they like InvITs which are constantly churning assets or adding assets rather than the more passive ones.
Got it.
Right.
As my next question is for you, Dr. Chaturvedi. As we read couple of tower assets, we understand that this tower assets need a lot of diesel to run the normal operations. Here, how do you see the migration towards clean energy in the form of battery? We heard that some migration has started, but in your view, how do you see this migration from diesel to battery backups?
This subject is very close to my heart, incidentally. This transition, the good news is already underway. The reliance on diesel, especially in rural and off-grid locations, right, which is still about to the extent of about 40% of the total portfolio, is both environmentally and financially unsustainable. So we are seeing a strong shift, in fact, on multiple counts. Like first one is using smart storage, which is lithium ion and life PO4 battery systems as such, more efficient. The other is solar DG hybrid models. So wherein like you only use the TG on a need basis, right? Otherwise, it's stored in the solar as such, which is a more efficient way, and you are able to control and avoid the carbon emissions. And then increasingly, remote energy management systems are getting installed now. That's the more efficient way of managing these energy assets as such. Now, government incentives, the regulatory framework in terms of reduction of carbon footprint, which is mandated, and ESG commitments are actually accelerating this. So we expect at least 40 to 50% reduction in diesel usage over the next 4 to 5 years. In fact, the goal basically is that the new towers that are now getting designed from the start, they should be able to operate on renewable energy compatibility. And the new norms which have now come in, thankfully, from the government side in terms of green energy open access, that is actually a shot in the arm right now, which will be very, very helpful to do this transition from diesel to non-renewables.
Understood. But in terms of cost-wise, how do you see this migration, diesel to batteries, in terms of cost structure-wise? Will it be in your favor, or it will add some cost for a tower company?
So, see, if you look at the diesel, as I said, it is financially unsustainable, right? Because diesel is not just about at what cost you actually purchase the diesel. There are many other nuances with diesel, right? You have pilferage, you have inefficiencies there as such, the whole ecosystem of diesel, filling and then utilizing it has a lot of inefficiencies, in fact. So if you just kind of offset that with whatever additional, incremental capex that you're going to put in terms of these new energy storage systems and also remote energy management systems, you will be in a win-win scenario.
Understood. Got it. So I'm sure the audience has been anxiously waiting with some wonderful questions. So let me start taking the questions from the audience side now. This question is for you, Mr. Gupta. Question is that with the telecom license validity being 25 years, how are we looking at the expiry of the license, considering TSAs are valid for 35 years?
Sorry, I could not follow. You said licenses are valid for a period of 25 years.
25 years, yeah. That's the audience question.
I think maybe then the fact itself is not right. I think there are two things. One is that there is a telecom license, and then the way we used to get the telecom licenses earlier, which now expired for all operators, those validity used to be the 20-year period. What we now acquire is a telecom license, and again, there is a telecom policy which is under draft as we speak. Some part has already been done, but there is a discussion to kind of get it to this licensing period, which is more administrative part, from 20 to 30 years or 25 years. So that is one. More importantly, the spectrum, which is the key. Licensing just allows you to operate, but you require spectrum to have your operations in place. And the spectrum validity in that sense is for 20 years. Government or the DOT has kind of earlier proposed validity of 30 years, but given that creates a larger upfront payment from the operator's point of view, I think we are still continuing with a 20 years kind of a spectrum auction and the spectrum validity period. So that is where we are.
Understood. Got it. So next question is for you, Dr. Chaturvedi. Given the fact that large part of tower portfolio in the country is a bit old now, how do you see the maintenance capex requirement for tower companies, as it does not necessarily adds up to the tower count, and could it really impact the ROCs of tower companies as far as maintenance capex is concerned?
Yeah, so I think we need to understand this capex in the right perspective. See, this is a very critical but often overlooked issue. See, over 50% of the tower infrastructure is more than a decade old, right? Which was mostly built during the 3G and early 4G rollout.
Correct.
Now, these towers require structural reinforcements, they require electrical upgrades, they require revisiting the grounding and the fire safety systems as such. Now, it's true that the maintenance capex doesn't add to the tower count, but it ensures the longevity of the asset, safety, and load bearing capacity, which is a very tangible addition that when you come for the 5G upgrades, for example, and new technology adoptions as such, right? The loading capacity comes in very, very handy, which also is an additional source of revenue, right? So I think the investors and the stakeholders need to view this instead of calling it as maintenance capex. I would suggest it should be called as protective capex.
Understood.
This is very, very essential for sustaining the service quality and reducing the downtime.
Got it. So it's not going to be a counterproductive thing, is what I can summarize it.
Yeah.
Right.
Rather, it's a necessity.
Understood. There is a question for you, Mr. Vashistha. Apart from counterparty risk, which is obviously the key risk which you see, what are the, as far as funding a tower or a fiber business, what are the key credit matrices you look at? Key matrices, be it in terms of leverage, be it debt service coverage ratios, or any other matrices? What are the comfortable matrices for you?
You see, obviously, and I did touch upon this in the earlier question as well. More than the credit matrices, I would again touch base on some of the risks that are very pertinent to lenders, and then the matrices flow from there. So clearly, we are seeing a lot of institutional players now owning a lot of these assets, which brings us to the question of how to view this ownership profile from a long-term perspective, because most of this lending which is being sought is greater than 12, 15, 18 years, etc. The second is, of course, getting into the business risk assessment of how does the portfolio look like with the kind of specific MSAs which are entered into. The financial profile obviously has to include a thorough assessment of the working capital cycle. We are also slightly concerned on the capex requirement. All of us kind of agree that the capital intensity, capex intensity rather, is actually going to increase in the sector, largely on the urban density side. but obviously the benefits accruing from that may not happen so quickly. So a thorough assessment has to happen around that aspect very clearly. The output of all of this obviously falls into what kind of a servicing capability most of these entities would have, reflected in the form of debt service coverage ratios, etc. But we are also seeing that given that a lot of these MSAs are for long-term basis, a lot of these revenue profiling that we are seeing for such companies are now close to predictable. So the whole trust actually lies in how the collection efficiency improves and how the receivables improve. So that's the crux of the credit matrices the lenders would look at when they're looking at funding a tower stroke fiber business company. Yeah.
Understood. For paucity of time, this is the last question which we'll be taking. This is for you, Dr. Chaturvedi. Do you see any substantial risk from satellite-based internet in the medium term? At least in short term, we don't see, but in the medium to long term, do you really see it as a potential risk for a tower or a fiber assets?
See, as you rightly said, in the short to medium term, there's a very limited direct risk, in fact, because satellite internet, like the companies that we are hearing now, which have got the licenses, Starlink or OneWeb for that matter, they're best suited for remote and inaccessible regions, where terrestrial infrastructure is not viable or feasible, because there are challenges like latency, regulatory approvals, high user costs. They basically limit the competitiveness. But actually, it may serve as a complementary layer, in fact, especially in disaster recovery, defense, remote education, for that matter. Right? So it's actually going to be a very healthy, way of looking at access. If you want to talk about that, where terrestrial access was not feasible, right? Satcom will come in very handy. But for dense urban and suburban use cases, right, terrestrial networks supported by fiberized towers, that will remain far more scalable and cost effective.
So in summary, you are saying it rather than a competition, it would be more of a complementary thing for a tower business.
Absolutely. Yes.
Thank you again to our guest speakers for their insightful views, and it was an absolute privilege to host you all. I'll now hand over to Mamta to give her concluding remarks. Over to you, Mamta.
Thank you, Hardik, for moderating the session, and Arti for your presentation. Once again, we thank all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please write to us at the feedback mail. Goodbye for now. Requesting the tech team to kindly log off.
Thank you.
Thank you very much.
Thank you so much.
Thank you, everyone.
all.
Thank you. Thank you, everyone.
Thank you.